We're here to talk about the Silicon Valley real estate marketplace ending the week of July the 4th, presented Saturday morning, July the 5th, about a 45-minute presentation. These are the key chapters, so you can jump to the part that is most interesting to your situation. Let's get right into the data slide. We'll start off with something new. This is what is the surprise of the week, inventory. Inventory is down significantly from last week. The ones in the yellow are sort of caution because inventory is down over 10% week over week, which is more than I would expect. Here the green is down less than 5%. So you can see there's definitely a split, and then each county. So you can see the areas near Silicon Valley, San Francisco, San Mateo, Marin, Santa Clara, and Alameda County are down the most, anywhere from 10% to 15%. And that's total available inventory. And that really caught me by surprise. Yes, inventory does drop into the holidays, but not by that magnitude. And then the areas where there was basically no drop was Napa, Solano, Santa Cruz, Sacramento, San Joaquin, and Solano. Monterey actually had an increase in inventory. So something is going on. It's very unusual. We'll see this when we compare it to the normal. Stay tuned for that. Here is a summary of the different micro market areas. You can see again, the green is year over year comparison. So basically on the green side, you're very blue. So the market is slower than it normally is, or is favoring the buyer more than it normally favors the buyer. And then this is the raw count, and you can see that you're mixed. There's some areas that are favoring the buyers. There's some areas that are favoring the seller. There's some metrics that are favoring one or the other. So it's clearly a mixed bag. The orange are delayed because we need sale price to do the overbidding, and then appreciation and sold price. And I follow the 10 percentile, the median, and the 90 percentile. So it's sandwiched, or is just a reflective of the most expensive and the least expensive. Here's what I've been following recently is the number of sales. We did bump up with an increased number of sales. We will go down this week because of the holiday, July the 4th. You can see how that normally impacts the data, but the main story is still a lack of sales, lack of offers accepted, but we are off the blue line. Here we're showing some key indicators. The first one is inventory. This is the active inventory as of this morning at 1 minute after midnight, basically at midnight. We went from 2,500 listings to 2,800 listings, so an increase of about 375 listings. But more notably, we went from 135% of the inventory you'd expect, significantly above the gray line, to only 7% above. And it's sort of shocking the amount of decrease here. It doesn't look that steep, but you were almost at the blue line, and you're down now almost the gray line, and you did that in just 1 week. And it's already taking into consideration the decrease of inventory that you typically see for July the 4th. We'll talk about this later in the presentation. It's a much bigger decrease than I was expecting, and one of the biggest decreases I've ever seen, if not the biggest, except for at Thanksgiving and at Christmas. I think what's happening is, for whatever reason, this July 4th is becoming a more significant holiday with more travel. It may be the fact that it's a 3-day weekend. It may be COVID-related pent-up travel demand. I do remember hearing that we were expecting record number of travelers, but this is a pretty significant decrease. It's a little bit over 11% of the total inventory disappeared from last week to this week. That means in 9 more weeks at that rate of disappearing, we'd have zero inventory. Clearly, that's not going to happen. In fact, I would suspect this is going to bounce back up next week. The real key is it going to bounce up to just below the blue line, or is it going to go over the blue line? Obviously, only time will tell. But that's going to be the thing I'm going to focus on next week, just out of personal interest, is how much of this 11% drop that we had from last week to this week will recover next week. The offers accepted have been floating around the blue line for the last several weeks. We're now at only 2,100. That's basically 100 less than we were at 13 weeks ago. But more noticeably, we went from 84% of the normal level of offers back here 13 weeks ago to only 76%. So we've lost another 7 percentage points of the marketplace, which is starting to get significant. But we've been at about 3/4 of the number of transactions closing and offers accepted for significant periods of time, probably sometime third or fourth quarter of 2022 to present day. That's ballpark where we've been the bulk of the time. So we clearly have lost a significant chunk of the marketplace. Whether we'll ever get that back or not is hard to say. I will point out that the number of transactions has been dropping my whole career, dating back to the early 80s. It just slowly decreases, which really doesn't make any sense when you think about it, because the population and number of housing units is always increasing from year to year. And I think it's just people are getting locked in because of property tax and capital gains taxes. And, some of the changes that they made recently have come too late. People have more than 250,000 exclusions, so they're not going to transfer their property tax under Prop 19 because they're way over the 250 exclusion level per person. Number of transactions, these are the number of closings versus number of offers. They went from 89%, so a higher percentage of closings just a quarter ago, to 72% now. So the number of closings has dropped down significantly more than the number of offers. The number of transactions that close can't be greater than the number of offers accepted. It can be lower because of transactions that fail, but there is a 3 to 5 week lag time on when when a typical offer gets accepted to when it closes. So they can be different as you're seeing that, but they're both volumes of transactions. Closed transactions is what the industry gets paid on. Offers that get accepted that fail are just frustrations for the industry. Days unsold inventory is the turnover rate of the industry, the seller-buyer balance, the supply-demand balance. We talk about days of unsold inventory, at least I do, 40 days. Most of the country uses months, but to say 1.3 months is pretty ridiculous in my opinion. And we're much faster than the rest of the country. Most of the country considers 3 to 7 months to be a typical range of normal months of inventory, which would be somewhere between 90 and 210 days. And so to them, talking about months makes sense. We're typically under 40, even though I consider like 6 weeks to 11 weeks to be balanced. And, maybe weeks would have been a more appropriate number to talk about, but it would be fractions of weeks. And so I've done days just, because it's what I picked out initially. Weeks might make more sense since I believe there's such a weekly cycle, but you can get to weeks simply by dividing by 7. Anyway, we went from 142%, so slower than normal, to 142%. So we're still slower than normal, and that's the percentage above the gray line, and you can see it's roughly the same level. And what are we talking about? Well, in a quick marketplace down here on the red line, you're doing it in 29 days. The typical is 33, and right now we're at 47. The slowest you'd expect is 45. So we're actually slower than the slowest you'd expect, which is why we're above and have been above the blue line. So this marketplace is slower than we've really been out of the last 10 years. And it's not 100% accurate because I use the 90 percentile instead of the 100 percentile for determining the slowest marketplace. And the quickest marketplace would be the 10 percentile instead of the 0 percentile. Days on market is very similar. This is how long does it take 3 out of 4 sellers to sell this past week? It's 31 days. That's 75% longer than it typically does. You can see just 13 weeks ago, we were right at 100% at 17 days. Now we're at 75% longer at 31 days. So not quite a doubling in the last 13 weeks, basically going up 1 day every week. Because if you take 17 and add 13 to it, you get 30. So we basically, every week, it's taking a day longer for those 3 out of 4 sellers to sell. I don't know if that trend will continue, but you can see that it has been continuing upwards for the time, in the recent time. Earlier in this year, there was a time shift where the peak happened earlier and the valley happened earlier. It will be interesting to see what happens next year on the timing of it, whether this was just a one year shift in the clock or if the schedule has been changed for some reason. Price adjustments. These are the price adjustments sellers make prior to getting the offer accepted. It's only 0.6%, which is a small number, but that's 3 times what it normally is. So a quarter ago, you typically only taking 0.2% price reduction up here on the gray line. Now you're down here on the blue line, and now you're back to the blue line. It looks like we're back, but we're still taking 187% of the reductions you want. So typical 75%, and so we're taking 1.4, which is almost double that 0.75. The most you'd expect, the soft market is 134. We're at 139, which is why we're just below the blue line if you look at that very carefully. Overbids really isn't a leading indicator. In fact, it's a lagging indicator. 13 weeks ago, we were getting 8.7% over the seller's ask price. Typical is only 6.8%, so you're getting 1.9% higher over the seller's ask price. Now we're only getting 4.4% when you're typically getting 7.4. So now you've gone from above the gray line to significantly below, and that's 3 percentage points below. The least overbidding you'd expect at this time of the year is 3.7. But that says it all in a nutshell. To expect 3.7% more than the seller's asking price when you're in a slow marketplace, just gives you an idea of how superheated Silicon Valley marketplace is. Here now, as we're looking at the three key indicators over a long period of time, we're looking at inventory in the purple down here. You can see how dramatically it's been coming down, and you can see the more abrupt drop off. And this is compared to normal. So if the drop off for the holiday was normal, you would have been right up here. So the drop off is more significant than normal. So we're getting back to more typical levels. We're getting rid of the surplus inventory that we've had. And you can see the rise up is pretty rapid. The rise down is pretty rapid. It's just a little surprising to see total inventory moving like that. Offers accepted has been bouncing around and it's down here right around 75%, maybe 76% for this particular week. But you can see that that's still where it's basically been for the last couple of years, all the way back here until, you could probably say that fourth quarter of 2022 onward, we've been bouncing around 75%. So we're clearly having less transactions than we should be having, but it's been a fairly reasonable, stable number. Then the speed of the marketplace is measured by the turnover rate, that is days of unsold inventory. Many parts of the country talk about months of unsold inventory and consider 3 to 7 months to be normal range. For us, I consider normal to be 40 to 80 days, 6 weeks to 11 weeks, something of that order. You can see that we really slowed down, which is a deterioration of the market turnover rate. And then we've been improving. And because of the drop in inventory, we've had a dramatic improvement this last week. Now we're looking at each one individually. Now you're starting to see some indication on the purple line here. Look how significant this drop is. And if you look back over the purple line, there's no drop anywhere else. And when I saw this, my first reaction was my data's wrong. Right now, I'm confident in my data as reported by my sources. There's some of the multiple sources I use to verify this. Are they having a technical issue that's underreporting inventory? Because you've got 10 and a half years worth of data here, and you've never had a drop like this before. And even the normal drop, this is the normal gray line right here. This is the kind of drop you'd expect for the holiday. We're having a drop that I would say is about 5 times greater than the drop you'd expect based on the past 10 years. So what I'm doing is basically saying there's something going on in inventory. I'm confident in my numbers, but I don't know if those numbers being reported by 2 different sources, because I checked it on both my sources, they're the same, but they're both numbers that I personally or professionally don't believe. So we'll stay tuned. And it's also interesting that it's impacting the Bay Area and not the whole region. So something's happening local and not global local, not in the Bay Area. In other words, it's only the areas most influenced by the high tech. So I don't understand it at the moment. Here now, again, is looking compared to normal. So if there was no change compared to normal, it'd be flat. So you basically went from somewhere, maybe, I'm not sure the scale on this, about 17.5% more inventory than normal, down to something like 7.5%. So you've dropped almost 10% of your inventory in 1 week. And again, there's been some fairly steep things in the past here when you're doing it on a percentage basis, but this is, again, one of the steeper ones, because you can only do 1 week, and it's hard to only do 1 week on a tight metric. So you're going from here to here in 1 week. Back in 2019 would have been close. It was a longer duration over a longer period of time, but look at, here you've sort of matched that. So something's up with inventory. Here's the offers accepted. You can see that we're down here. We're still right above the blue line. These are offers accepted in the past 5 weeks. It's still a lack of offers. Here's compared to the normal. So you're down here right now at that 75% line that goes back all the way to 2022. Here's days of unsold inventory, the turnover rate. The improvement this week is basically based on the reduced inventory. So whether the market's actually faster or not will depend on whether my inventory numbers from my sources is accurate or not. You can see that normally it declines going into the holiday, and then it jumps significantly after the holiday, and that's because people will put their house on the market this week. So next week I expect lower number of offers because there wasn't new inventory this weekend, and going into next weekend I expect a jump in the inventory. Here again you can see that versus typical. So we're still 42% slower than normal. The turnover rate is slower, and you can see the climb basically up for the first quarter and a half of this year, and now the half of second quarter, there's been basically a turnaround and an improvement. But we're still at fairly record high slow turnover rate based on the past 10 years. Here's marketing time. This now is an easier to understand concept for the plain consumer out there. How long does it take for 3 out of 4 sellers to sell? Right now, it's only taking 31 days, which is very reasonable. But normally here in Silicon Valley, with our quick turnover rate, you're down here at 18 days. So you're taking a little bit more than 50% longer than we typically do in Silicon Valley based on the past 10 years. Here is, you can see we turned over and had a slight improvement. That might be just a little statistical fluctuation. See how you've had these little bounces before, so we can turn around and go up. We will probably have a decrease in DOM, not next week, but the week after. And in fact, next week's probably going to be an increase because they'll have longer listings. The listings that sold were probably going to be on the market for a longer period of time since there's less new listings this week with 0 days on the market. The week after, there will be a lot of those new listings selling and it will pull it back down again. So it'll probably go up and then down. Here's the sellers that are taking the largest 10% price reductions. And these are the reductions that the sellers are taking in order to entice the buyers to write an offer on their particular property. So these are seller price reductions before they accept the offer. You can see that it's down on the blue line. So some of those most price reductions the sellers are taking, and the 10% of the sellers that are taking the largest price reductions right now are taking about a 13% price reduction. So that is a fairly significant number, but it is still in the realm of normal. Here now is that compared to normal. So you're taking about a 30% greater price reductions than we typically are doing. And again, that's on the 90 percentile seller. Now this is the average seller, and this number is a lot smaller at 1.4%. And that's because the vast majority of the sellers take no price reductions whatsoever. They do their homework before the house goes on the marketplace. They come on the market. They sell the house without ever doing a price reduction. So you can see that the trend here typically breaks right at the beginning of second quarter. We broke, wherever you want to call it, the real peak was here. But, was this really a dip? But by the beginning of second quarter, we were on and dropping more rapidly than we typically do. What I try to do is when you're in a cool marketplace, you try to compare it to the cool marketplace, and the cool marketplace doesn't break until the halfway through second quarter. But a normal marketplace breaks earlier in the year. So you sort of have a difference on the time when the market changes. Here is the average. So what typical would be up here on the gray line. So you're taking a little bit more price reductions, but you can see those price reductions have been decreasing recently. So they're still more than typical, but they're less than they had been just at the end of first quarter, beginning of second quarter. Here's the frequency. So how common are the price reductions? So price reductions right now are getting more common than they typically are. About 21% of the sellers. So 1 out of 5 sellers is doing a price reduction. Normally you're down here at something like closer to 1 out of 8 are doing a price reduction. Now it's 1 out of 5 sellers are doing a price reduction before their offer comes in. Here is on a percentage basis. So you're basically 60% more frequent than you typically are. Here's overbidding, and now this is a lagging indicator because it takes time for the data to reflect on what the sold price was. You can see that we've come down quite a bit, and right now the overbidding is 1.5%. Right now we're having 1.5% overbidding. Normal overbidding is up here at about 4.5%, 5%. So you're quite a bit below. If I'm doing my math right on the fly, that would be about 3.5% below where you normally are overbidding. So here you can see, yep, it looks like it's very close to 3%. So right now you're 3% less overbidding than you typically did. And that's an absolute raw count. So normally if the overbidding is at 5% over the seller's ask price, right now it's at 2% over the seller's ask price. Here's the frequency of overbidding. Right now it's only 60% of the sellers are getting overbids. And when I say only, that's because it's typically up here at about 75%. So you're 15% less sellers are getting overbid right now than are typical. But still, to say that 60% of the sellers are getting more than their asking price says something about the supply-demand balance here in Silicon Valley. Here's the frequency compared to normal. So you're only at about 82% of where you normally would be. So fewer sellers are getting overbid. You can see that's come down fairly dramatically since about 2/3 of the way through first quarter. And it's been in a straight line. It does look like it's flattening out finally. Here's my pricing models. You can see that we're now a little bit below the first blue line. Basically, you can either draw one straight line at 11.4% rate of appreciation and you're cross through there, or you can do a 12.5% for 7 years and the last 2.5 years, much flatter at 3.3%. I could even make an argument to come up here at something like 12.5% for 7.5 years, and then basically flat on the price for the last 3 years. Here now are my distributions. We have 3 different distributions of different metrics. What we do is we start off a year ago on the dotted line, which is down here. The purple line is the current line. So you can see right now the days on market are quite a bit longer. You can pick, the 75th percentile is what I normally use right here in my analysis. You could come out here and look at the 90. The reason I don't use the median, look how close there is. There's almost no difference between last year and this year, but that's probably less than 1 day difference back here. And you come up here to 75 percentile and you clearly have, a significant difference. I mean, if from here to here is 20 days, I can only eyeball it. There's about a 10-day difference, and down here, maybe a 2-day difference. A 2-day difference, you're just going to chalk that up to noise. That's why I don't look at median. I don't look at average, because you have one property that's on the market for a year and finally sells, it pulls up your average. And that's why we use percentile. I use 75th percentile, 3 out of 4 sellers. Best week we ever had was back here, and the worst we had is way up here. You can see the purple, the current line is clearly worse than the current line. We'll start off on the dotted line a year ago. We'll go a week at a time. You can see that normally that first week was a jump up, another jump up after 3 weeks. So normally this is when the market's starting to cool off. Then we get into sort of the summer doldrums where it really doesn't move around much. So what would I expect? I'd expect the purple line to slow down and then not move around very much. What's going on? Why did it? Now it continues up, and there's the end of the year slowdown, and that was the slowest of the year. Now you're rapidly improving. There's already slowing down again. And now it's just doing the normal spring cool down. And we're getting close to the current week. So that's about 3 weeks ago, 2 weeks ago, 1 week ago, and the current week. Again, what I'd expect, a little bit more cooling off and then an increase. And in fact, with 4th of July, that's exactly what I expect. I'd expect days on market for next week to increase because there's not as many new listings with 0 days on the market. And the week after, I'd expect an improvement. And then after that, I'd expect it to be sort of level of where we are. So we're not going to see much change, most likely, in time on market for the foreseeable future. Now we're looking at the largest price reductions. The reason I call it the largest, we go up to 97.5 percentile. We ignore the top extreme of 2.5, and we only look at what the 17.5% of the sellers are doing. Why? Because most of the time at 17.5%, you're at 0. Now we're clearly not at 0 price reductions right now. We're at about a 3% price reduction. So 17.5% of the sellers are doing a 3% price reduction. So that is not 0 by any stretch of the imagination. Here's the worst week we ever had, which was December 27th, 2022. The best week we had was just a little earlier that same year, Valentine's Day of 2022. We're stepping through. And again, these are seller price reductions before they get the offer. And now I'd expect it to slow down dramatically. There's sort of the bottom of the marketplace right there. Rapid improvement. There's the fastest in the marketplace, February 21st. And now you're slowing back down again. Coming up to the current week fairly soon. 3 weeks ago, 1 week ago, now the current week. So you can see that the price reductions are quite a bit larger across the board. At the very high end, they're not that much larger. They go from 89% to 87%, so 2%. But you come down here at the 15 percentile seller, it's 0, and now they're taking a 4% price reduction. So that's a fairly significant change from 0 to 4. Here we're looking at the buyer competitive overbid, and this is a lagging indicator. So this is what's the market conditions were 3, 4, 5 weeks in the past. Same concept. The current week is the purple down here. So you can see there's significantly less overbidding. In fact, that's probably the worst line, maybe not the worst, but close, one of the worst lines of overbidding. So there's almost the least overbidding in the past 52 weeks. Right now, we'll step through. You can see where you're deteriorating at this time of the year. So we expect to go now from the purple line even further downwards. You can see the summer stability right through here where it's just bouncing around. Now around right after Thanksgiving, it's going to start plummeting right there. And now you have the rapid spring run up, and then there's the peak of the market, April 5th. And then you're cooling off. So 2 weeks ago, 1 week ago, 1 week ago to now current week. What do I expect to have happen? I expect this basically not to move much, but it drift down a little bit and then be stable. But anything can and does happen. But the big takeaway is we're having less overbidding now than we've had any time in the past 52 weeks for the most part. Now we're looking at the 3 counties that make up Silicon Valley individually. San Mateo County down here in the orange, Santa Clara County in the blue, and Alameda County in the gray. And you can see all 3 counties have dropped down dramatically. And, there's long periods of time here, but it's the steepness of the slope. And I can't find another period of time for all 3 of these counties to have this kind of drop. I checked my data from my sources. That is accurate. I am questioning my sources right now just because we've never seen this in 520 weeks and then another 26 weeks. So in 546 weeks, almost 550 weeks, we've not seen a drop this significant in total inventory. And for 3 counties to do it, something is abnormal. Now, it could be as simple as a lot of agents use July 1st or July 4th as their expiration date, and all those listings came off at midnight last night. It's possible. I just have a hard time believing that right now. And if anyone out there has an idea why inventory disappeared overnight, please let me know. Here's your offers accepted. The offers are fairly reasonable. San Mateo County has the least, below where they typically were. Both Alameda and Santa Clara County, Alameda in the gray, Santa Clara in the blue, are below where the offers were. And I forgot what the numbers were, but basically 75% of where we would expect to be. Here's your days unsold inventory, the turnover rate. So Alameda County has the longest turnover rate. Santa Clara County has the fastest. San Mateo County is pretty close. And again, these all drop mostly because of the drop of inventory. Here's days on marketplace. You can see that Alameda County in the gray actually went up and has the longest. San Mateo went up. Santa Clara actually improved slightly by about 2 days, but it's still at 26 days for 3 out of 4 sellers to sell their properties. But even Alameda County with the longest is only at 35 days. So that's just a little over 1 month. And again, keep that in perspective that a lot of parts of the country consider 3 to 7 months to be normal. And we're talking about it being slow at just over a month. Here's the magnitude of the seller price reductions. You can see that Alameda County is doing the most price reductions. San Mateo County is doing the least. And Santa Clara is close behind at about, well, they're all between 1.5% and 1% price reduction. So fairly normal. This is the average weighed down by all those sellers that did their homework correctly. Here's the ask price frequency. So basically, right around 1 in 5 sellers are doing a price reduction in Santa Clara and in San Mateo County. It's a little bit higher in 22% in Alameda County. So Alameda County is doing the biggest price reductions, the most frequent price reductions, and has the longest marketing time. Now you're having the overbid. Alameda County, the one that had the longest marketing time, the most price reductions, is having the most overbidding. How can I possibly explain that? Basically, what happens is sellers resist doing price reductions. Then when they take a large price reduction, they overshoot where the market is. And then the buyers realize that's now a good price, and they come in and overbid the reduced price. They could have come in by themselves a week earlier before the price reduction and probably gotten a price lower than their overbid and maybe even lower than the seller's reduced price. But they wait until the seller reduces their price, and then they overshoot that price. So Alameda County has the most overbidding at almost 6%. Santa Clara County is just under 4%, and San Mateo County is probably close to 3% overbidding. And that's on average. This is the frequency of overbidding, all very close together at 60% of the sellers are getting more than their asking price. So 6 out of 10, 3 out of 5 sellers are getting more than their asking price. Here's the long-term appreciation. Santa Clara County has got the most appreciation at about 115%. I will point out that something that's happening in Santa Clara County is the high-end areas, Los Altos, Palo Alto, Saratoga, Los Gatos, are selling almost the normal number of homes. Your affordable areas, East Central, South San Jose, Milpitas, Cambrian, are selling significantly less homes than they normally do. That causes a shift where the high-end homes are a larger percentage of the marketplace. And that will pull up your median price, which is what the appreciation is based on, because this is county-wide. So this 120% appreciation, when you get down and look at the micro-market data, you'll see that no area has 120%. It's the market mix shift that's causing that large inflated appreciation rate. Here's your sold price. San Mateo County is now again under Santa Clara County Again, in part, the market mix would play into that. Alameda County is the more affordable. We're basically down in all three on current prices and the current trend. Here's the same information on regular paper. The previous was on logarithmic paper. And here are your estimated payments. I did not update this slide for this week. Sorry about that. Here's your micro market data. Here's your active inventory. So you can see areas in blue have more inventory. You can see a shortage of inventory in Saratoga, Los Gatos, and Cupertino. The only two areas that have a shortage. The rest of it is either white, which would be a balanced marketplace, or blue favoring the buyer. Here's the offers accepted, very blue across the board. But notice how Los Altos, Palo Alto has 9% more offers than normal. And Cupertino, Sunnyvale, an expensive area, has actually 3. I mentioned Saratoga, Los Gatos, but I'm incorrect on that. That's basically right where the valley is at about 72%. But Cupertino is still above your median and Los Altos above your median. So these two are the expensive areas that are pulling up the rate of appreciation. Because notice all your other areas are down here under 80%, and we have a low in Morgan Hill at 56%. Here's your speed of the marketplace. You can see Cupertino is the only red area on the marketplace right now. The rest are balanced. Los Altos is close to being red at 14% above. Any higher, it would have started being a shade, but that's the highest you basically can be and be white. And also, just for those that may not be familiar, I do have the county-wide data. I have Silicon Valley-wide data, plus 20 micro markets under each one of the county datas. Here's your days unsold inventory. You can see a wide range, nice dark blue out here in Livermore. Morgan Hill is a blue, but then you also have these bright red areas like right now in Cupertino and Sunnyvale, sort of widespread. And this is based on the metric by itself. So even though the market may be slow compared to where Silicon Valley normally is, in areas like Cupertino, it's still fast. In areas like Santa Clara, it's still fast. In areas up here like Hayward, it's still fast. Here's marketing time, that 75th percentile, and this is compared to the 10-year median. And maybe I should have pointed this out. I have the 10-year comparison and the regular, and because this is so blue, I want to, which says the market's taking a longer time to sell, I want to compare that to the raw count, which is the next slide. So instead of grouping all the 10 years together and then all the raw count together, I'm just opposing them so you can see the shift in the marketplace. So even though we're slower than we were the previous slide, we're still reasonably fast turnover time for marketing time for 3 out of 4 sellers. Now you go back to the 10-year comparison, and this is on price reductions. So more price reductions than we normally take, and you can pick whatever favorite area you want. But the price reductions that they're taking are still fairly small. Yes, this is blue, but I mean, blue at less than 2% price reductions, blue at 2.5%. That's not a huge price reduction for any particular seller. Here's your ask price reduction frequency compared to the 10-year. So more frequent price reductions than normal across most of the region. And then here's the actual numbers. So when you look at the actual numbers, you have a fair amount of pink involved. So yes, it's favoring the buyers more than it typically does, but that's still a strong marketplace. And that's the point I'm trying to make, or the data's making. And I thought it was better to just oppose the two instead of going and compare the 10-year and everybody think the market's slow. And then you get to the raw numbers and everybody goes, wow, the market's actually not so bad. So now you're comparing one metric right after the other. This is the average buyer overbid. So right now in Milpitas Berryessa, there's 3% overbidding. Campbell, 5% overbidding. Cupertino, 8.5% overbidding, which I think is probably the biggest except for Berkeley and Alameda, the city, the island, where there's 16% overbidding still occurring today. This is the frequency of overbidding. You can see the least amount of overbidding on the coast and the expensive areas in San Mateo County. Everybody else is pretty much red in color, which means it's fairly frequent. It means more than half the sellers are getting overbid. Here's the appreciation since the last 9 months, and this is where we look in Santa Clara County. Not a single area has gotten over 100% appreciation, but Santa Clara County is at 116% appreciation. And this is since the last 9 months of 2015. This is because some of the expensive areas, which I think were Los Altos, Palo Alto, and then Cupertino, Sunnyvale, were selling a greater percent, and they have 84% and 61% appreciation. So even though they have, not a lot of appreciation compared to the 120% we saw earlier, I'm not sure why the 120% and the 116% are slightly different. I will look into that for next week and try to explain that. they should be the same. And then even in the San Mateo County, you can see that your expensive areas actually had the highest appreciation at 102%. Big shift, 102% down to 41%, down to 39%. And then the cities, Redwood City, and then the Bay cities, right around 70% appreciation. So, when you start looking at Santa Clara County, it's somewhere around 90% appreciation, which is very good compared to 70% for the bulk of San Mateo County. And then if you look at Alameda County, I might pick out something like 85%, but you got to note that both Oakland and Berkeley and Alameda, two different micromarket areas, have had very low appreciation long term, similar to Redwood Shores, similar to the San Mateo County coast, and even similar to Los Altos and Palo Alto. Here now, instead of following just the median number, which is the middle number, I sandwich it by following the cheapest 10 percentile on the left and the most expensive 90 percentile on the right, and you can figure out what area you're interested in and what price range that area is going to be in. And this is for single family homes. Here's a summary chart. So you basically start off with Silicon Valley across the top. And here I went back to my old method of comparing all the green, which are year over year comparisons, so that you can see how blue that is and how much is favoring the buyer. And then you come over and you have a more mixed bag when you look at the raw count, and then you have your lagging indicators, and then your appreciation and your price. Here is the number of offers accepted. I think this is the second worst year, which is why I'm giving it the blue. It's the second worst year out of 10 years, and Microsoft agrees with me on that, giving me only 2023 having a lower number at 1915. But for the 25-year number, it's telling me there should be another number year. And I looked across it. It's not that hard. But I can't find a number lower than 2095, basically lower than 2100. Here's the raw data for Santa Clara County, San Mateo, and Alameda, as well as Silicon Valley. You can look at what metric you're most interested in. You can see a number of new inventory is down, which is to be expected. The unexpected thing is look at the drop in the total number of active listings. 11% across Silicon Valley, almost 11% in Santa Clara County, 15% in San Mateo County, and 10% in Alameda County. These drops are what I am having a hard time with. These numbers up here are the current inventory, last week's inventory here. I manually checked it. My sources say those numbers are accurate. When you have 550 weeks on your screen and you don't have a drop anytime like that, I question the input data. It's not my input data. It's not my calculation of the data. It's my source of how many active listings there are on the market right now. Anyway, you can pick the metric that you're most interested in, and you have the appreciation not only from the last 9 months of 2015, but also the entire year of 2020, so if you want to look at the appreciation since the pandemic. And with that, we've been talking about the Silicon Valley real estate marketplace. We will talk about the Greater Bay Area, 13 counties and 5 regions. This blue YouTube archive link here, or you can type in the shorter green root URL. If you want to join the presentation Saturday morning at 9 a.m., type in the green root URL in 2025. The password is up here if you need it. The handout is not up there. I'll try to get that up there by 10:30. That's the handout of this week. Actually, I think I'm up to 72 slides. And if you want any specific past episode that you know of, you type in the green root URL and the year, date, month code. I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers or sellers in Silicon Valley on single agency transactions. Moving on to the Greater Bay Area, these are the 5 regions. We've already talked about Silicon Valley being Santa Clara, San Mateo, and Alameda County. Cities is San Francisco and Marin. North Bay is Sonoma, Napa, Solano, Contra Costa County. Central Valley is San Joaquin and Sacramento counties, and Central Coast is Santa Cruz and Monterey. Here's the inventory. Notice the dramatic drop in inventory in Silicon Valley, as well as in the cities and even in the North Bay. There's a little bit of a drop in the Central Valley, like you'd expect, and almost no change at all in the Central Coast. It's this huge drop in the Silicon Valley that really caught my attention. I don't see any time when there was been a 1 week drop of this significant. Here you have a several week drop of roughly the same magnitude, but a 1 week drop, it just bothers me. I know my data is accurate. I'm just not sure that my input source is accurate for this week for some reason. And it would impact the Bay Area counties more than the outlying areas, because there's a reasonable decrease in the Central Valley for the holidays. There's no change in the Central Coast. It's just the 3 regions that make up the Bay Area that have me concerned. Here's the number of offers that accepted. You can see that the trend is up in the North Bay. Basically, the only exception is clearly down in Silicon Valley, flat in the Central Valley, flat in the cities, and flat on the Central Coast. So offers is pretty flat. Next week, I would expect that to drop down. Days unsold inventory, the turnover rate, you can see this huge decrease in the cities, and one in the Silicon Valley and one in the North Bay. These are accentuated by the drop in inventory, which I'm not sure I believe at this point in time. Marketing time, how long does it take? 75%. Look at the city's climb. It's continuing to climb. It's gone from basically 27 days, 28 days down here, probably 27 days down here to 50, almost a doubling in just a matter of a few weeks. Silicon Valley's been doing a steady climb. Everybody's been doing a steady climb. Clearly, the market's slowing down. It normally slows down the second half of the year, or actually, frankly, the 3 quarters of the year. But, you know, it's just noteworthy that it's the cities is the one that's most noteworthy. Ask price reductions. These are the sellers' average ask price reductions. You can see Silicon Valley is taking the least amount of price reductions. Central Coast is taking the most. Remember, this averages out, including those sellers that take no price reduction whatsoever. This is the frequency, or so how common is it? Look at what's happened in the cities. It's gone from basically something like 14% of the sellers taking a price reduction to 32%, more than doubling in just a short couple weeks. Silicon Valley's been doing a steady climb. All 4 regions have been doing a steady climb. The San Francisco, the cities, has done just an outrageous climb. The rate of climb is significant. Here's the average overbid. You can see it's been going down in all 5 regions, most significantly with the higher regions being the most overbid, being the cities and Silicon Valley, clearly going down in the North Bay, going down in the Central Valley, going down in the Central Coast. Steady downward directional pressure. The more overbidding, the more the decline tends to be. Here's the frequency of overbidding. You can see the Silicon Valley has gone up from basically 74% down to 60%, so a drop in 14%. The cities has been basically flat, just shy of 68, 69% of the sellers are getting overbid. Then you drop down to the North Bay at just 42%, the Central Valley at 34%, and the Central Coast at 28%. So you got 2 up here, the cities in Silicon Valley up in the 65% range, and then you have 3 down around the 36% range. Here's the long-term appreciation. I've commented earlier about the rapid appreciation in Silicon Valley being accented by the shift in the marketplace, where more expensive areas are doing better as far as volume of sales than the more affordable areas. That inflates your appreciation rate. And here it's showing it that 196% appreciation, or 96% appreciation. I'm going to have to go to investigate the 120% appreciation on one of my earlier slides. And then you can see the Central Valley is right in there. And it's also had a market mix area. It's got areas like Mountain House that are expanding rapidly in the last couple of years, and they're more expensive than your San Joaquin typical property or your Sacramento typical property. Santa Cruz is just bouncing all over the place. It depends a lot on what's selling at the given time. North Bay is climbing at 70% appreciation, and the area that's done the least well is the cities with just under 50% appreciation. Here you have the long-term pricing for the Greater Bay Area. You have cities up here with the highest price area, basically a little bit below their 2022 peak. You have Silicon Valley that's basically a little bit below their 2022 peak. You have the Central Coast, which is a little bit below their 2022 peak. You have the North Bay area, which is a little bit below their peak. And you have the Central Valley that appears to be just a tad below their peak. So all 5 regions are basically still below their 2022 peak pricing. Here's the estimated payments, and I did not update the slide for this week's interest rate change. So these are current information based on this week's sold price, but last week's interest rate. So sorry about that. And here's the raw numbers. You have the now is the raw number for the particular metric, percent change from 1 week ago and percent change from 5 weeks ago. So a lot of information packed on this one particular chart. And again, here's the chapters you can jump to in the YouTube description. So the big takeaways are what we started off with, which was the inventory. A huge drop in the cities in the Silicon Valley in individual counties, you have San Francisco, you have San Mateo, you have Marin, you have Santa Clara, and Alameda County doing 10 to 15% drops in total inventory. I checked my data. My data is accurate based on my input data. I question the input data that I have no control over. I'm going to watch it carefully for the next couple of weeks. I've never seen something like this before, but these are the kind of magnitude drops that I would have expected, 5%. But you're getting 10 to 15% drops. And when you looked at the chart earlier in the presentation, the graph, there was no time in the last 550 weeks where the drop was this significant. So something happened. It's noteworthy. It's worth paying attention to, even if the data, it's more interesting if the data is accurate and there was that kind of drop. Anyway, that's it for this week. I don't see any unmuted mics. Have a great week. Take care. Bye.